Public pension money is not meant to be a political lifeline for a sports team, and turning it into one could quietly dump a huge bill on ordinary taxpayers. And this is the part most people miss. Even if you love the Connecticut Sun, forcing retirement funds to carry the team is a very different thing from being a loyal fan. Connecticut Governor Ned Lamont has suggested using state pension assets to buy a share of the WNBA's Connecticut Sun in order to stop the franchise from moving to Boston. The basic idea is simple: if the state becomes an investor, the team has a reason to stay put. It may sound like a clever way to protect a beloved local team and score political points, but as an investment strategy for a public pension system, it raises serious red flags about risk, priorities, and fairness. The state's $60 billion retirement plans and trust funds exist for one primary purpose: to pay the retirement benefits promised to teachers, police officers, and other public workers. These funds were not designed to act as an emergency rescue fund for professional sports franchises or as a tool for local economic development projects. When politicians start steering pension money toward highly visible, emotionally charged projects, it blurs the line between prudent investing and political showmanship. But here's where it gets controversial: should retirees' futures be tied to whether a sports team stays in town? This proposal arrives at a moment when a Boston-based private equity group led by Steve Peglica, a minority owner of the Boston Celtics, has reportedly agreed to buy the Connecticut Sun for $325 million and relocate the team to Boston in 2027, assuming the league signs off. That kind of offer underlines an important point: sophisticated private investors are already willing to take on the risk of this team with their own capital. If politically connected investors are prepared to bet on the Sun, why should state pension funds, which are supposed to be conservative and diversified, be nudged into the same gamble, effectively with taxpayers standing behind it? Over the last several years, Connecticut state and local governments have finally started to dig themselves out of a fiscal hole that built up over decades. Reforms like spending caps, guardrails, and extra contributions to the pension systems have helped reduce bonded debt, improve pension funding levels, and even earn credit rating upgrades. These are not flashy reforms, but they have made the state's financial position more stable. Using that progress as justification to chase politically popular investments, however, risks undoing some of that hard-won credibility. In other words, recent success is an argument for staying disciplined, not for loosening standards. Even after this progress, Connecticut still has one of the highest per capita levels of public employee-related debt in the country, including unfunded pension and retiree healthcare obligations. The pension trust also assumes a 7% annual investment return when calculating how much needs to be contributed each year, yet over the last couple of decades it has only achieved an average return closer to the mid-5% range, while broad stock market benchmarks like the S&P 500 have done substantially better. That means there is already a gap between expectations and reality, making every investment decision more critical. Introducing a politically motivated, high-profile, and relatively illiquid asset like a WNBA team into that mix only adds complexity and risk. If this were truly being considered as a purely financial investment, it probably would not be rolled out in such a public, symbolic way. A genuine, return-driven investment is one the pension fund would be willing to buy and sell based solely on financial considerations, without political pressure to hold on even when it no longer makes sense. That kind of investment also assumes the state would push for whatever business decisions best enhance the team's value, even if that meant moving the franchise out of Connecticut. Ask yourself, would lawmakers and the public really tolerate that kind of cold, bottom-line thinking once the state is financially and emotionally invested? There is another twist that could spark debate. Political entanglement may not just hurt the pension funds, it may also be bad for the team. The Connecticut Sun would arguably be better off with owners whose primary objective is building a championship-caliber franchise and maximizing its long-term success, wherever that leads. When the dominant goal is to keep a team in one specific location for political reasons that can conflict with decisions about facilities, markets, media rights, or expansion opportunities that might actually make the team more competitive and financially secure. Is it fair to the players, staff, and fans to anchor the team's future to political geography rather than performance and growth? From a pure investment perspective, professional sports franchises can indeed be lucrative, especially when media deals, branding, and league growth break in their favor. But they also come with a unique bundle of risks. Team valuations can swing with changes in ticket sales, sponsorships, broadcast contracts, and the economic health of the local market. Unlike shares in a public company that can be bought or sold quickly, a sports team is highly illiquid. There are only so many qualified buyers, and sales require time, negotiation, and league approval. That lack of flexibility is particularly problematic for a pension fund that needs to manage liquidity and risk across a broad portfolio. If the Connecticut Sun turns out to be a poor investment, the direct financial hit would not fall on the public employees in the pension plan, because their benefits are legally promised. They are still entitled to receive the pensions they were told they would get. The shortfall would instead land on taxpayers, who would eventually have to make up the difference through higher property, income, or sales taxes, or through cuts to other public services. That's the quiet risk behind the feel-good narrative. The emotional appeal of saving the team today may translate into higher tax bills or reduced services tomorrow. That is why pension funds are set up as fiduciary vehicles. They are legally and ethically obligated to act in the best interest of beneficiaries while prudently managing risk. They are not meant to be piggy banks for favored projects, no matter how popular those projects may be in the headlines. In this framework, any potential investment in a sports team should be judged by a single core standard. Does it maximize risk-adjusted returns for retirees and taxpayers, compared with other available options? If the honest answer is no, or even we're not sure, then the investment does not belong in the pension portfolio. Supporters of the idea might argue that keeping the Connecticut Sun in the state has intangible benefits: community pride, local jobs, tourism, and role models for young athletes. Those are real and meaningful positives. But the controversial question is whether those broader social benefits should be funded by a pension system whose primary mission is to safeguard retirement security, not to underwrite civic amenities. If the state believes the team's presence is truly that valuable, there are more transparent tools like direct subsidies, tax incentives, or public-private partnerships that can be debated openly on their own terms rather than hidden inside pension fund decisions. Finally, the broader policy conversation around pensions matters here too. Organizations and experts who work on pension reform emphasize that long-term success comes from clear rules, realistic assumptions, diversified portfolios, and resistance to short-term political pressures. When pension money is diverted to high-profile, emotionally charged projects, it can undermine trust in the system and make future reforms harder. People begin to wonder, if politicians are willing to use retirement funds to keep a basketball team from moving, what else might they try to finance the same way? So here is the big question for you: should a state ever use public pension assets to keep a sports team from relocating, even if many residents passionately support the team? Do you see this as a smart, innovative way to protect local culture and economic activity, or as an inappropriate gamble with taxpayer-backed retirement money? Share whether you agree or disagree, and why, in the comments. This is one of those issues where reasonable people who care about the same community can end up on completely different sides.